Jonathan Wells, why don't you
Yeah,
give us your quick intro and tell us what you know? Take it
sounds
away.
good. Sounds good. Yeah, definitely. Well, thank you everybody for having me back 2 years later, right, to talk about roughly the same thing. And so we'll kind of dive in. I love that kind of open forumness thing going on. So we'll have some fun at that. I do sometimes run in with these Zoom calls. I do not know why, but sometimes my mic will leave. Just keep in mind, I will hear you if someone says, I can't hear you anymore, right? It takes me about 30 seconds. I figured out my little technology thing of take the USB out, plug it back in, and magically I'm back. So yeah, real technical things, but it happens along the way. So a little bit about me. I'm sitting here in very warm Minnesota.
Oh,
I'm in the Twin Cities area of Minnesota, and I am a born and raised tax accountant since I was a whopping 9 years old. My dad was a tax accountant. I did my first tax return when I was 11, and I'm now 48, so I've done a lot of them. And but it's changed, right, over the years. The game has changed, the rules have changed. We played Life for a while, then we played Monopoly, and now we might be playing Sorry, right? I love that one. Uh, and so today is, all about kind of what I've got toddlers at home, and so I love to use the primary versus secondary color metaphor, right? And so we talk a lot about in taxes and tax maneuvering and tax minimization, all the things, right? Like we know that the IRS and our states, our local states, most of our local states charge taxes, but our local states tend to be some of the bigger expenses we have in a year, right? I mean, it's up there. And so when we earn a dollar, we want to keep a dollar legally, right? As much as we possibly can in that regard. So we're going to talk a bit about those strategies. And digressing, we're going to talk about one of the primary colored strategies. There's a few of them. My top three primary colors are one is related to entity selection, and others related to secondary companies, symbiote companies, and a third is related to like legacy related stuff, nonprofits, creating your own 501(c)(3), some of those kind of things. Those are real big ticket items. We're going to focus in on the entity piece today. And then we'll talk a little bit about the secondary stuff. Right, just a little kind of value add if we have like kind of bonus time from questions in standpoint. So I'm going to have a little cue time at the very end. So kind of let me run through the gamut of it so you understand what this is all about. And I'm a huge why kind of guy, right? So I want really if there's takeaways from today, I want you to remember kind of the big picture, and I'll point to those as we get into it. But I also really want you to conceptually understand the why, because you don't have to be a tax expert as long as you can tell a story and you can understand, why we do it, what's that kind of thing. And then once you know that, now you can counter, Bob the neighbor saying you should do this, or the attorneys saying you should do that, because everybody's got an opinion, but oftentimes those opinion they don't consider the cost of those things, right? And I like to focus in on that because as we do things that tend to charge and have costs and fees and things like that, we want to have a fiduciary responsibility. All right. So I'm going to do some screen shares as well so you can kind of see this lovely guy. But one of the things we're going to focus in on here today is, and here comes the share, is really the entity selection piece, right? So what we're talking about here is making sure that we are picking none of those primaries, that entity selection. We are the right type of entity for the purposes of taxation. So again, the theme, the bias is all about taxes. I'm not going to put an attorney hat on and spin around 3 times and tell you all the legal benefits of this or the legal benefits of that. But I will look at it from the standpoint of the tax benefits of this, the tax benefits of that. Okay. All right. So the first part you really want to understand is the differences between the Fed and the state, right? And everybody remembers these old Venn diagrams from growing up as a kid. The concept there is that there are a series of federal entities. Like when we go to the IRS and we go, Mr. IRS or Ms. IRS, whatever it is, I would like to be this type of entity. And they're going to go, well, you have 4 choices, sir. You could be a sole proprietor, you could be a partnership, you could be a C corporation, or you could be an S corporation. That's it, right? But oftentimes people come to me and they're like, I formed an LLC. I formed an LP. I formed this thing. Well, that's this light blue ring here, right? Because our attorneys and all of our friends in the real world are, they're always looking at litigation and trying to prevent litigation and make sure there's legal protections. Well, the IRS isn't concerned about that. They're concerned about taxes. And they say, okay, that's great that you picked one of these. Now pierce that light blue, come into the dark blue, and tell us what you are in regards to how you want to be taxed, right? So many people in self-employment, I would say almost 9 out of 10 these days, create LLCs. 9 out of 10 create LLCs. I rarely see comma inks walk in the door anymore. Almost everybody comes in at an LLC. And I love that. Why? Because it gives us choice. We're sitting out here in this blue ring, and I have choice on how I want the IRS to treat me as the LLC. If I go down the comma inc, I only have two choices, C Corp, S Corp, right? If I go comma LLC, I have the choice to stay a sole proprietor. I could put it on my personal return, right? I could, maybe I have another partner in this LLC and I want to be a partnership. Maybe I want to be a C corporation for a certain reason, or maybe I want to be an S corporation over there as well. So I have a lot of flexibility in the LLC. That's why I love it when people come in with that, because it gives us a lot of choices based upon it. And the key to this is one of the takeaways for today. We make decisions from a tax perspective so that the savings of making that decision from a tax perspective, right? Like if I'm able to save X off of my taxes for choosing the right entity, I want to look at that number and compare it to the cost of doing that entity. And I'm looking for a return. That's it, right? So if I do this entity and I save $10, but it costs me 5, okay, that's a no-brainer. We'll do it, right? But if I do this entity and it saves me 3 and costs me 5, no, right? And that's the thing that the attorneys lack when they set these things up for people, is they don't understand that that's not their game, right? They're charging fees to set them up. They're not charging fees to keep them open on a compliance standpoint. So big takeaway, we make transition when there's some level of fiscal responsibility, when it makes sense to do those types of things. Okay. All right. So let's talk about these kind of the big three. I don't have partnerships on here. Why don't I have partnerships on here? When I said that was one of the 4 entities, that's because a partnership taxation is the same as a sole proprietor taxation times 2, right? It's the same as a sole proprietor times 2. It just means, if I'm a sole proprietor and I got a lemonade stand on the corner and I see, little Billy on the other corner selling lemonade, I could go to Billy and go, hey, do you want to partner up? You have a sole proprietor, I have a sole proprietor, let's create a partnership. It's taxed identically. The pros on it and the cons on it are exactly the same, from that perspective, right? The C corporation's a unique guy. Forming a C corporation is one of my primary color tax maneuvers. I love C corps, but I also really despise C corps at the same time. So it's kind of like, well, how does that work? It's like the little giant, right? How do you be a little giant? Well, there's a point that comes in everybody's life, hopefully comes in everybody's life where I look at them and they're making good money and they've saved and they've got retirement and they're like, you know what? I'm good. I have enough. I want to start structuring things for my family, for my legacy. I've got a death tax problem. I've got certain problems. We start to implement C corporation strategy in those to really exponent. Why? Well, the maximum C corp tax rate is 21%. The maximum tax rate for us individuals is 37. Max. Right? So if I got 37 and I can shift to 21, I like that idea, right? That's 15, 16% savings, right? So there's very, very good. But if it's my only entity and I still need the earnings and profits, it's a problem because we have what we call double taxation. That means that the corporation pays its own tax. And then once it pays me, I pay tax again. Uh-oh, we don't like that, right? So I point this out for the purposes of just understanding, because people ask me all the time, what about a C Corp? What should I do? C Corp, the benefit of a C Corp really is continuity. Typically, you have a board, but most C corporations are looking to sell or looking to go public. That's a C Corp, right? It's not very good for us. If we're in the arts in any way, we're most likely going to be over here, or we're going to be over here on the S corporation side. Okay. So one of the things you're going to look at when we look at the differences between a sole proprietor and S Corp on your screen, Notice that the pros and the cons are exactly inverted for each. They are. The pros of a sole proprietor are exactly the con of the S corp. The pros of the S corp are the exact opposite of the cons of the sole proprietor. Now, I can tell you what, the government and the IRS love these, right? If I have an idea and I start with my idea and I just go out and do it, I have created a sole proprietor. Do I actually need to do anything to create a sole proprietor? No, you don't. Do I have to go to the IRS and get an EIN? No. Do I have to go to my Secretary of State to register a name? No. If I have an idea and a whim and I'm out there and I'm working, you're just working as Jonathan Wells under my social security number, and I'm out there doing whatever it takes. I'm recording my revenues, I'm recording my expenses. That's great. Did it cost me anything to really set it up? No. Right. So it's pretty easy. The downside is the IRS kind of goes, ha ha, I hope you do well because we're going to get you. And that's exactly the case. It is the highest tax rates possible. Of course, if I was a government that loved money, which our government does and our states do, well, wouldn't I make it really easy to hammer you with taxes? Of course. Of course I would, right? That's we call that good taxation business for our governments, right? The problem also, though, is that it's got the highest audit risk. That means that if you go to the IRS right now and you look at the demographic of auditors, all of the aging ones are retiring and the rookies coming in are very, very green. Sole proprietors are the easiest to audit. They are. They're the easiest to audit. I could bring a 22-year-old kid in here and go, can you see if what they recorded as revenues and expenses match their receipts? Okay. Yeah, I can do that. Great. See if you find any discrepancies, let us know, right? We'll tax them on it and penalize them for that. So the audit risk is very high because it's very easy and they have a lot of staff that can do it. The audit risk is very low over here because of the idea that they have to hire somebody else. This is a separate tax return. This is part of your personal return. Okay. You don't get to just be over here without filing paperwork, by the way. This isn't just something like I get clients that walk in, they're like, yeah, I'm an S Corp. And they walk in, I was like, okay, show me the documents that prove me that you are this. And I don't have that. Sure enough, we call the IRS and like, no, this is not an S Corp. They never did the necessary work. Okay. So it does take effort to move down this, right? We default in at this. When I come back to this guy and I do a single member LLC, I go get an EIN number, the feds are going to deem you by default a sole proprietor. We haven't done anything beyond that. They want you to be here at the highest rates, right? They want us to be over there. They want us to be partnerships. They do not want us to go down the corporate entity path for the purposes of it. So now let's answer the why. Let's do the why. Now, this is a real analysis of an individual. Simple, really simple modeling. I didn't put in like a ton of mortgage interest and kids and all that jam. I just said, let's just drop some income in. Let's just pick a sole proprietor that makes 150K that has $20,000 of expenses, profiting 130,000, right? Making what's that, 11,000 a month. Pretty good little business. Well, the problem is here is at the end of the year when I sit down with little Billy and I say, Billy, you had a great year. Let's get ready to write that check. You got 46,000 hanging out, right? And they're going to look at it and go, whoa, right? I planned on 25, right? I didn't know that I needed another 20. And oftentimes they forget about this lovely thing called FICA tax, also known as Social Security and Medicare, AKA self-employment tax. They call them three different things in the tax code. Why? Because I think the government loves to confuse us. They make us think, they just rename the same tax in different ways. So if I'm self-employed, I pay self-employment tax. If I'm employed, I pay FICA tax. Funny, same rate, same thing, same limits, right? So it's always the same thing. And what is it? It's Social Security and Medicare, 15.3%, 2.9 Medicare, taxable to infinity, right? 12.4 Social Security, tax to whatever the Social Security limit is in that year, currently right around 170 to 180,000. Okay. So in this example, we're going to pay the full freight on 130, going to write a check for 45. So I sit down with Billy and I go, Billy, there's a better way for you. There's a better way for you, right? And it's one of those primary colors. It's like, hey, Billy, I'm not going to change the way you operate. You're still, you're out there, selling a ton of lemonade on the corner. This is great. You're going to keep doing it. You're going to keep your business name. You're going to have that LLC. You're going to keep your EIN. You're going to keep your bank account. Everything literally is going to be the same. You're not going to know any difference to your operation, except how we do taxes. That's it. It's a big secret between the client, myself, and the IRS. From there, in this exact example, you will see a slightly different profitability number here, 95,000. But this is, I said before, this is exactly the same example. Well, what it is I had to pay Billy in this example from his own business a $35,000 W-2. W-2. So that W-2 is a brand new found deduction that I did not have over here in that sole proprietorship side. That is required by law in an S corporation. I must have what they call a reasonable salary. We'll talk about that in a minute. Okay. We're having the same, there's no effect on income taxes. You'll notice I use Minnesota, but it doesn't matter, right? It could be California, it could be Arizona. It's relative. The concept here is it's relative. It's going to be the same number. This is not an income tax game. What this is a FICA tax game. I pay 15.3% on the 35,000. That's what that number is. 15.3% of 35,000, that newfound expense up here, right? For a total now of 32,824, because this 95,000 here is not subject to self-employment tax by law. It's been around since like the 1950s, the S corporation laws were. And when I first read it, I remember I was like 15 years old and I went to my dad. I said, is this true? I can literally file pieces of paper and not pay 15.3% on my tax burden. He's like, yeah, it's there. He goes, what do you think the senators all have? I said, now I understand how government works. And that's in fact, all their consulting businesses are S corporations, right? For a reason. So the other side is people say to me, is there risk? Is this law going to go away? And I just kind of go back to them and go, well, if all the senators have it, no, right? There's no chance they're going to do that. That would harm themselves, and we're not going to do that. So, but in this example, you can see just this little maneuver saved Billy 13 grand, right? That's a huge savings for somebody that's making this kind of money. That's real change in their life to have that kind of savings from it. But that's just a minor. Now, once we head over here in this side, then we start getting into our secondary colors, right? My minor tax saving maneuvers that every good smart business should do. It's called tax planning. It's the idea of saying, well, if I'm going to owe this, and I'm meeting with the client before the end of the year, it's what I do every day since September 1st. We're basically looking at, now that we know this, how do we bring it down even further? Well, one of the things in many states, if you have a state that has taxation, states have this thing called, they call it different things. They call it PTET, they call it PTE, they call it pass-through entity. They call it a few different like things, and I've seen them in a lot of states, but the majority of states now have this. And here's what it says in the state. The states will say, hey, since you have an entity, there's a rule, I think it's part of the Constitution, right? No double taxation without representation, right? Something like that goes on. Well, if you understand over here, if you're a sole proprietor, and let's say you are in Minnesota, in this example, you're paying $7,000 to Minnesota. Did I get a deduction for that $7,000? Did I actually reduce my tax bill to the feds? Or am I actually paying federal tax on my Minnesota tax, which is double taxation? You, in fact, are. If you live in a state that has tax, because the SALT limitation was $10,000, we'll talk about the big, beautiful bill. But because the limitation was $10,000, you typically hit that by your real estate taxes alone and maybe your car license tabs. So we would never get the value of this. Or maybe you just didn't have any mortgage interest, so it didn't really matter. So what the states did is they said, well, that's kind of not fair. So they instituted an entity level tax. This is only for entities, not sole proprietors, not Schedule C filers. And this entity level tax says, hey, you know what? S corporation filer. In Minnesota, I'll give you exactly how Minnesota works, right? But every state's a little different, but it exists. But in Minnesota, this is what it says. They said, take your profit, multiply it times 10%. Well, that's easy. Just drop a zero off, right? So what are we talking? We're talking 9,500. And so Minnesota says, if you're willing to pay us $9,500 before the end of the year, we're going to allow you to drop your federal taxable income, not your state, but your federal taxable income equal to the payment that you just paid us. So that $95,000 profit taxed by the feds would go down by approximately 9,500. So we're talking what? We're talking take 9,500 off of that. So we're talking like 85.5, right? 85.5. Well, if I just brought my taxes down by 9,500 times my 24% bracket, that's like a quarter on every dollar, right? Divide this thing by four, 9,500 by four, what do we save in there? 2,750 or something like that, 2,500, a little less, 2,250, somewhere in there, right? But we're saving an extra in this example, 2,086, just because, on top of the already organic savings that we have here. So what's important here is that there are savings. The takeaway when we look at entity selection is, number one, know the savings, know your numbers. Number two, are your numbers consistent? Once we make a transition, you don't come to the next year and go, oh, it was a bad year, I didn't make any money. Because the problem is once you make this and you dive in, it's like the Matrix, right? You took the red pill, you're in it. There's no going back. If you go back, you can. One time, they'll allow you to take the blue pill, but then you can never take the red pill again for 5 years. So they're kind of going, if you jump down into the shallow end of the pool, make sure your net income is consistent, right? Always trouble with real estate businesses, right? Like feast and famine in that industry. Killer years, bad years, killer years, bad years. It's almost cyclical like that. So we want to see consistency, because as we get into the cost of things, right? The average sole proprietor or single member LLC might spend $600 a year for all of the forms. And that's probably pretty heavy, realistically, right? If I had somebody that I was doing taxes for already and they said, Jonathan, I have a small business, I need to add that to my personal return. And they'll go, how much is it? I'll be like, $200, no more than $200, as long as I'm not doing a ton of accounting work for it, right? But the average S corporation, including payroll and all of the things, you're running about $5,000 a year. So if I'm going to increase my costs by 4,500, I better darn be making savings here, right? I want those savings to cover the costs, right? And I mentioned that in the beginning, fiscal responsibility. We don't just do things to do things in the tax world. We need profitability, and then we have savings. Now, here's what's awesome. Let's say we have people that they benefit, they're blessed, and they make more money. The costs to do this should not change. The work is related to the complexity, not that you have commas and zeros behind all your numbers. So those net savings grow very, very quickly. So oftentimes, what I like to tell people is, when do we make this, right? Takeaway point again for today, about 80,000 in profits. 80,000 in profits. That is the moment where, and again, consistency matters, but I look at that 80,000 and I go, yep, I should do this. I think I'm going to do at least that next year. I'll probably do a little better, right? So you got to make this decision for yourself, because once you go down and you take that matrix pill, you're basically signing yourself up for this for a while.
Hey, Jonathan,
Okay?
when you say profits, do you mean that income, the net income?
Net. Yep. Net.
Okay.
So gross minus expenses equals profits.
Okay.
Okay. All right. Now let's talk about what's in here, because this is important too, right? When I just threw this 20K in here, so you understand expenses. This is the storytelling. This is the takeaway point that I try to educate all my clients with, because I'm not there to make the decisions of how they spend their money on a day-by-day basis. I'm just there to kind of clean up the mess at the end of the year. And the concept here, by definition, right? It's your Jeopardy question of the day. I remember I saw it one time on Jeopardy, and it was final Jeopardy question, and it was, what is ordinary, necessary, and not excessive? And I literally was like, wow, I got final Jeopardy. And that is, what is a tax deduction, right? Ordinary, necessary, and not excessive. You notice nowhere did I say, well, people will call me and they'll, can I do this? Can I deduct it? And I'll often tell them, I'll go, will you tell me? Can you deduct it? And I'm like, well, this is your job. You're the tax guy. Tell me if I can write this off. I said, is it ordinary for your business? Is it normal for somebody in your line of work to spend the money on this? Of course it is. All my guys are doing this, right? Yeah. Okay, great. Is it necessary? Now, necessity does not mean causation of failure, right? So many people are like, it's necessary. If I don't take this medication, I will die, right? We're not talking about that in tax code. Necessity is all about efficiency levels. It's the ability for you to maybe do more. Remember, the IRS is your partner. They make more when you make more. They do not want to harm your ability to make more. So necessity is pretty loose on that because they know they want you to make more because then they do better, right? Excessive is the interesting one. And a quick aside, because we've got a little bit of time here, we're moving pretty quick. I read a court case of a guy that had a delivery service, and he went to court over it because he bought 8 Bentleys, brand new $2 million he spent on Bentleys, delivering white glove stuff, and his model was terrible. He lost a ton of money, and he wrote it all off. And he offset like distributions from retirement accounts, other income, right? He maximized his benefit for this loss. And he got audited. And the IRS is like, well, of course you needed cars. Of course. But you didn't need Bentleys. You could have bought Kias and you would have done a lot better. And it went to court. And the judge actually said, sorry, IRS, you do not control his model. If he wants to buy Bentleys for Bentley delivery service and he wants to lose money, that's on him. But you can't define how somebody runs their business and try to use the excessive terms. Where excessive comes in is if I was a tax accountant and I was like, you know what? I love gold, solid gold pens. They would have a problem with that. That's excessive, right? But not when it comes to modeling, from that type of thing, from a business model. So just remember that when you're thinking about your expenses, that's a takeaway for you today to keep track of those. Earlier, I had mentioned this $35,000 W-2, meaning that we need to have some level of reasonable W-2. What's great about this is we go over to the Bureau of Labor and Statistics, BLS. I can look up any industry in any location to see what the average compensation for that is. Well, oftentimes there's a very, very wide spread to that W-2. Now, our motivation is to keep the W-2 low. Why? It reduces Social Security and Medicare, of course. It increases profitability, right? Which increases the ability to do PTE, which also increases what we call the QBI deduction. I haven't talked about it, but it's called the Trump tax cut. 20% of our business profits come right off the top through that cut. So the more profit I have, the better. I want to keep the W-2 low. The IRS wants me to go high. We try to find something that is on the lower side of it within reason. If I have somebody up here whose profits and net income is 950,000, right? It looks something like that. I'm sorry. I'm not W-2ing you for 35K and allowing you to maintain 950,000 in profits. There is reasonability to the nature of profits. Typically in that regard, if I have somebody that's making that kind of money, I might bring this number up to 100, 120, still maintaining a heavy amount of savings even at that number, okay? So the Bureau of Labor and Statistics is exactly what the IRS uses. This is how they do it when they audit people on this type of thing, okay? Some of the common things that I get when it comes, people talk to me about sole proprietors, they're like, hey, I can put, this was old, but this was when I built this, was a few years ago, 55,000 into a SEP. I'm going to change this number right now because really it's 70. I can put $70,000 into my SEP retirement plan as a sole proprietor. And that is, yeah, you definitely can. You definitely can. But here's the kicker. Over here, for someone to be able to put 70,000 in, my net income number as a sole proprietor needs to be about 260,000. At 260,000, the SEP contribution is eligible up to that lovely 70,000. And I'm able to defer 70,000 for the purposes of taxation. That is great, great, great. But here's the problem. How big is this number when this number is 250, 260,000? It's a giant number, right? It's a giant, giant number. And that's a problem because if this number is $40,000, basically the logic for this argument is, wait a minute, I get to pay $40,000 in tax that I'm not ever going to recoup. It goes nowhere. Poof, gone into the wind. Social Security, Medicare, right? But it allows me to defer 70. So it saves me some income taxes on that. So maybe it's going to save me, 32%, but it cost me 15.3. So there's a little savings there. You are absolutely right. There is. But here's the problem. When I start to pull this out in retirement, it's taxable. Its growth is taxable, dollar for dollar at a rate we don't know. Right now, today, as we sit here today, these are the lowest tax rates in my 25-year career. Why would I trade this? The lowest tax rates in my career for the purposes of having a higher tax rate later, just so I can put and defer and save a little bit because I'm paying an unbelievable amount of FICA tax over here, right? Because couldn't I just have a simple little solo 401k over here and I could actually defer 23, 24,000. And if I'm over 50, I can put another 8 in. I could almost take this whole W2 and send it to a 401k. And I only paid 5,300 in FICA, not 40,000 to be able to put the 70,000 in, from that side. And what people don't know is if there's anybody here that's above the age of 65 in the room, they probably know this little word called IRMA. IRMA. And what IRMA is it's a sliding scale of your income to your Medicare premiums when you get into Medicare. And your Medicare premiums will slide based upon your other income. And if I have a gigantic amount in retirement plans and I have to pull this out, plus Social Security, plus maybe something else, it could slide me into the next IRMA scale. And all of a sudden, my Medicare premium went from 170 a month to 350 a month on top of it. So careful with these accounts. The government wants us to do these accounts. They really do. My favorite account from a tax perspective is what we call the non-qualified account. The kids call it Robinhood. But it's basically you're just putting money into Schwab or Vanguard and you're investing it. You're paying taxes on dividends, interest, and capital gains. You can save it for retirement. You can control the taxes. I love it. Of course, people come back and they'll, but what about a Roth? I love a Roth. Absolutely. Roth is great too. Very difficult to get money into a Roth if you're making money. It's very, very hard. So I don't get down to that, but it's an individual thing. If you can do a Roth, of course, do it. But the secondary account is this. I only do my qualified plans if and only if, right, I'm forced to pay FICA. I never do qualified plans if I have a choice to pay FICA. Okay. All right. That's the key on that piece. So digressing, takeaways. We make maneuvers when it makes financial sense to make the maneuver, when my tax savings exceed my cost to operate, right? We understand my audit risk is the lowest on an S Corp. It's the greatest on the other side, right? And the concept here is you're going to have the best outcome if you're profitable. Key word, key sentence, if you're profitable for that. Okay. All right. Last 2 minutes. Let me share with you the Big Beautiful Bill Act and things that people don't know that's in there. The number one thing that's in that bill is the continuation of the status quo. So in 2018, the Trump tax cuts basically changed the game. We were playing Monopoly. Now we're playing probably, well, let's say we were playing Sorry. Now we're playing Monopoly because it is a little better. And so we've been playing Monopoly and we thought Monopoly's ending at the end of this year. Well, the Big Beautiful Bill gets passed. And in that bill made permanent, keyword permanent, the tax codes that the game that we've been playing, right? The rates are the same. The QBI is the same. The child tax credits are the same and actually a little bit better for that, right? Now, there was some things that were added to that will affect most people. And the number one thing that has been added, which is very, very good, especially if you live on the East Coast and the West Coast, if your income, single 250, married 5,000 is under that threshold, your SALT deduction, the state and local income tax, that's an acronym, state and local tax, SALT, right? What is that? That's our state taxes we pay, probably on our W-2s or our quarterly estimates. That includes our real estate taxes on our home, and that includes our ad valorem taxes on our toys, cars, right? Car tabs are an ad valorem tax. I add all three of those together. Historically, we could not exceed $10,000 since the year 2018. That has moved now to $40,000 if our income is below. Congratulations for those that are. It's a beautiful thing, right? It's the number one thing. A couple other little provisions, and then I'll open up for a Q&A. Anybody over the age of 65, anyone over the age of 65, married income under 150, individual income under 75. It's not the most giant number. You get an increase in your standard deduction. This is the how much you get kind of tax-free every year. You get an extra $6,000 to help offset the taxation on your Social Security. Most everybody knows this, but they don't know the dynamic of it. Your tips and your overtime. If you're in a tip industry and you are getting tips, and your income married is under $300,000, $25,000 of tip income as a deduction, $25,000 of overtime, same $300,000 threshold. And then last but not least, if you have a new car purchase assembled in the US of A, new car purchase starting in 2025. This does not include your old cars bought. If you bought in 24, you don't get this. It's new cars bought in 25 and your income, single 100,000, married 200,000, you're below that up to $10,000 of the vehicle interest being tax deductible. Those are the new things from the big, beautiful bill. So with that, it's showtime. Questions, Q&A, answers.
Christy, you had a question. Are you still here? I'll read it. Christy wrote, posting a question I have to drop early. I'm an S Corp. I have friends in the same line of business. Their accountants don't require them to pay taxes till the end of the year. They just take distributions throughout the year and then they pay taxes at the year end. My accountant says it's required to pay taxes every month if I take a distribution or officer compensation or whatever you call it. What's the real deal?
What's the real deal here? Now I'm a realist and I love like logic and I love understanding and I love understanding the purposes of laws. What she's referencing here is what's called the estimated tax penalty. It's the idea that a self-employed person, just like a W-2, what's a W-2 do, right? Every paycheck, bing, 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 they get taken out. When it's a self-employed person, you're on your own, I guess, honor system to make a payment. Well, if I pay all of my taxes, I'm self-employed. If I paid all my taxes on April 15th, the government would penalize me. But the penalty would be determined based upon actually the year before's taxes. It's kind of confusing, but understand that. And once I understood it, and I have a video on the YouTube channel that explains this, but the concept is the government has no idea what you're going to do for 2025. As we sit here today, they absolutely have no idea how your year is going to be. So they're not going to control how much you have to pay them based upon your 2025 numbers. The determining factor of how much you pay them quarterly is actually built upon your 2024 year that you filed. That's what they know. So if I look at my 2024 year and I look at my total tax on my tax return and I subtract out the withholding on W-2s and it says, well, at the end of the year on April 15th, I owe 20 grand. Does that mean I need to pay 5 grand a quarter for every quarter to get to cover that 20 grand? Well, maybe, right? I don't know what the withholding is the following year, but it's basically whatever that total tax number is. You multiply it times 110% because the IRS loves growth. They want growth out of you. They want growth in their pockets. 110%, subtract out the withholding from W-2s and 1099s that are organically done under the understanding it will be there in the next year. So many people do it wrong because they quit their job and they do quarterlies built upon the prior year, but they forgot like, oh, I had withholding that doesn't exist now. Right? Well, that had to be thought about when you're deciding the quarterlies because the IRS doesn't care about that. They care about total tax. It's a line right on your tax return. Multiplied times 1.1, divide by 4. We want it quarterly. And that's the law. And if you don't do it, they charge you a 7% penalty. Now, here's where it gets interesting about this question. You asked me this question 3 years ago. I go, I ain't giving it to them quarterly. And here's the reason why. Yields in bank accounts are like 4 to 5%, right? 2 years ago, 4 to 5%. Money market accounts was great. The estimated tax penalty was 2.5% for most people. It's a win-win. I'll wait. I'll pay the penalty and I'll keep and I'll make the yield on my money. It was great. Well, the IRS got rumor of this. And in 2024, they moved it to 7%. They said enough is enough, folks. You cannot hold on because think of it from the government's perspective. If I let everybody pay their taxes on April 15th, what's the probability that most people cannot pay? Much greater than people that pay ratably during the year, right? Much greater.
Speak for yourself, government.
Oh, yeah, sorry. Right. Yeah, but it's true. It's factual. It is how it, it's how it works. And so that's why they add the penalty to it. Now there are tricks to it. Like we have this W-2. Could I not take this W-2? So this is the interesting part. If I write a check to the government, any of you write a check to the government right now, we send it in or we go to irs.gov, they know the date, the time, and the amount, don't they? The moment that sucker was cashed, they do. But if I have withholding on a W-2 or a 1099, do they actually know when that came into them from these big institutions? They don't, do they? They have no way to timestamp the payment on your W-2 or your 1099 that you had withholding on. Boy, is that a loophole. Could I write a payroll in December and have a big withholding amount on that payroll because I was behind on my quarterlies and get out of a quarterly estimated tax? Oh, yeah, you can. We do it every day, all day, right? So there's a little bit of truth in this question for both parties, right? The law is the law, but there are some workarounds. Now, I don't know the details of how this is going, but I like the latter account that says required to pay taxes every month if I take a distribution, because the IRS looks at it and goes, Billy, you're taking 10 grand a month of profit out every single month. You're telling me you're going to do your W-2 in December? You're going to pay yourself 10 grand a month, but you don't pay your FICA taxes until the end of the year? Yeah, that's a problem. That's a problem. Only under audit is it a problem. Do they have any auditors out there? No. They're hurting from that side. So that's the gist of that question. Okay. Other questions?
Go ahead, Roger.
Hi, Roger Klein. I pay my estimated quarterly. I understand the 110%, but knowing that with the additional SALT and additional senior discount deduction, I won't I won't get to the same level I was last year. So as long as I
Correct.
pay what I think will be 100% and I'm correct,
Yeah.
that's good. That's
That
okay,
is
right?
good. So
Okay.
there's a secondary rule we tax accountants never like to talk about, Roger, because it's like if you ever play darts and maybe you drink too much and you put a blindfold on and you go, the dartboard's over there, hit the bullseye, right? We're never going to hit it. So we accountants don't like it because it's not objective, it's subjective. But here's the secondary rule outside of that 110%. What you're referencing is what's called the 90% rule. If at the end of the year, using the current year, this is why it's the blindfold in the dark with the dartboard metaphor, because who knows? Right now, we have a good idea of what our taxes are. But in June, do we? No way, Jose, right? There's too much that can change. So the IRS says this: if if at the end of the year you calculate your total tax for the current year, not looking back, right? That's the 110% rule looking back, but the current year. And let's say that number is $100,000 in taxes. We'll just throw it out there. Okay. And during the year, you had a better year before and you're coming down and there's new tax provisions and there's new tax laws. So you think your taxes are going to drop. You need to hit, in my example of 100,000, you need to hit 90% of that number ratably during the year. So my quarterlies have to perfectly get me to within the 90%. So I have a 10% threshold of error on the current year taxes, hence the blindfold metaphor, because we don't quite know. And how do you know in April when the first quarter is due or June 15th when the second quarter is due? It's hard, but that's what you're going to use. And you just kind of have to guesstimate, right? If that's a great word, to figure that out.
Well, for 2025, I've been paying towards the 110%. Now, with my fourth quarter due, I know what I've made and what I expect deductions
Yeah.
will be.
Yeah. And you'll be fine because those first quarters are heavily weighted on the penalty algorithm. Early money is good, right? I do a lot of that and I have some people that'll come in. I had one guy, I was like, why didn't you call me? He was making massive quarterlies and his business fell off a cliff. And I was like, you should have known, right? I'm like, we already made our fourth quarter. I was like, oh gosh, okay, well, big refund, right? But yeah, you can always finagle those as you go on, and you won't see a penalty if you're within the 90% threshold. Okay. Other questions?
Brian.
So currently, I am in the bucket of being just a sole proprietor, and I have been for years.
Yeah.
Frankly, just because I didn't know better. And if I'm going to make a change, does it
Yeah.
make sense to make it whenever, or should I do it at the beginning of a year, or
Yeah.
how does that complicate things?
Yeah, that's a great question. So the IRS does not prefer people to attempt to backdate these things. Now, can we? We actually can. There is a backdate. In fact, I gave a presentation a week ago to a person that's like, right? He like literally grabbed me after class and strong-armed my arm and he goes, how do I do this backdated to January 1st, right? Like, I'm going to get killed if I don't do this. And I was like, all right, we can move some mountains in this regard. However, the law is you have 75 days of backdating without a special request to the IRS. So you have until March 15th of a year to backdate to January to be inclusive in this. Now, the kicker though is if I'm a sole proprietor and I'm up here and I haven't created and I'm just working as Brian, you cannot backdate Brian. It must be an EIN number with at least an LLC taxed like a sole proprietor. You have to have the entity to have the ability to move over into that S corporation, right? So again, if it's just me and I don't have a
Yeah, and
name, then
and
that's
that's what it's been up to this point. Is that I just do it all under my social.
oh, yeah. So your first step, so you're logically would be looking at 2026. If your income is consistently above that 80K threshold, then you go form the LLC. Brian, what state are you in?
And Texas, actually. So
In Texas. Oh,
no,
beautiful.
no
Beautiful
state
state.
income tax.
Yeah, no, lovely, lovely state. You said one of my top 5 favorites. Love me some Texas. I was afraid you were going to say California because they charge $800 a year just to have an LLC. It's
Yeah,
crazy. And so it's great. You get an LLC, Secretary of State, right in Texas. You don't have to go to Nevada or Delaware like these big
true.
corporations do. They do that, by the way, to just hide ownership names and that kind of stuff, but it's not a tax game. And then from there, you file the necessary paperwork to become the S corporation. You're off and running in 2026.
Gotcha. And so you're saying basically, essentially, up until about March 15th, I've got the ability to backdate that starting
Yep.
in for 26.
Yep, you could.
Okay.
And then as long as you don't wait too long, even if you were like April, May, June, you could still get it done. It just requires a couple extra steps
Sure.
of backdating. Like literally, I just had one signed today, backdated to January 1st, 2025. And we'll get it through. It'll take a little bit of a battle, but we'll get it through. The
Sure.
toughest piece is these S corporations have to have payroll. So that's the hustle now for people is I got to get that payroll done. And they don't even have a payroll system. So that's the tricky part when we're analyzing it. Is that cool? Is that clear?
Sure.
Okay.
Yep.
And that's kind of why I did this in December too, is because I know January you can start fresh. Like start fresh, get your entity going and you're off and running. I did start mine like January 8th, I think is actually my date of filing S Corp way back in the day. And the other thing you just touched on, Jonathan, when you do become an S Corp, you have to file payroll. You have to have payroll system down. You have to
Yep.
file monthly taxes with payroll, all that stuff. And I scrapped my way through it for many years, but I missed a payment here. Like I just screwed up. I finally went with the payroll service, and I know Jonathan, you offer
Yeah.
that. Your
Yeah.
company offers that. I went with one of the generic ones online, but here's personal handholder too. I
Yeah.
think you guys should know
Yeah, and
that
that's
it's
kind of like
worth every penny.
when I have somebody that calls me and quotes, that's why I try to include the payroll because it is the payroll process. I mean, Nancy, bless you for giving it a shot and getting through it. That's crazy.
I did it for a
I
while.
literally I can see every form with my eyes closed. I know exactly how to do it. You know what? Paychecks Corporation, thank you. You do a great job. And I don't have to. Because it's also incredibly inexpensive for what they're doing because they have the technology that's doing it quickly without error. You make a mistake on payroll taxes, it's a 10% penalty for the first day late. 10% penalty for 1 day late in payroll taxes. Why? Payroll taxes are trust taxes. It's not these taxes, right? These are income taxes. This is more honorary. Trust taxes are like sales tax. It's somebody else's money. So they penalize that stuff heavily. So yeah, always wise to have a payroll system do it for you. It's not worth the pain. It's
Yeah,
$100 a year.
I did it for a while, but yeah, you mess it up, you're so screwed. So yeah,
Yep.
Jonathan's company does offer that service, and for how much money I know we all make, it's worth every penny to have someone do that part for you because I know what you make an hour, right?
Yeah.
It takes too long to muffle through that stuff, and it's really important.
Yeah. Other questions? Excellent.
All right.
If nobody else has anything, I'll actually throw one other thing out there about
Do
the S corp. From your standpoint, I've got a mixture of 1099 and W-2 income coming
Yeah.
in for
Yeah.
various companies that I work for. I work for probably about 10 or 12 different companies a year typically.
Yeah.
And so is that a huge burden to deal with from a standpoint of?
Not really. I mean, you're going to issue, what you're talking about here is oftentimes my advice when I run into that, like I've had a lot of like models and things like that, and it's the same game, right? They're getting paid from everybody.
Mhm.
I try to get them to go back to the sources, specifically the W-2 sources, and go, hey, can you pay my LLC instead? Right? I always start there to try to get it because again, you want to get the key is you want to get as much money into the S corp as possible as your main source. Then from there, you do your W-2 out of that, and you don't have it. But it's okay. You definitely go to the 1099 folks, give them what's called a new W-9, right? This is the
Mhm.
backside of it, and you just give them the new EIN number, and then you'll fill it out appropriately. You'll let them know that you're now an S corp. And in fact, what will magically happen is they most likely will stop giving you a 1099 because it's no longer required. As soon as you check the right box that you're an S corp, they still may. Some companies do, but it has no effect. 1099 reporting is for individuals because they cheat on taxes. That's why.
Copy that.
Businesses are a little bit tougher.
And most production agencies now, Brian, also if you are an S corp, you get the cash. You're on your own.
Yeah.
You don't have to go on their W-2.
Yeah.
Yeah.
We got a
Most-
hand raise in there. Is it Yuval?
Yuval.
Yep. The biggest question I think of like going to S Corp, I live in New York and I
Yeah.
know there's a lot of corporate taxes. What I can't figure out is does the corporate tax rates that are New York based kind of outweigh the benefit of going to an S Corp?
So understand that an S corporation by definition is what they call a pass-through entity. So what you're referencing is the corporate tax rates in my example under the C corporation. Okay. So New York's tax rate, what you're talking about is really a C corp. It's an entity that pays its own
Got it.
tax. Remember, the S corporation pays no tax. You do. And this income flows through to you on a form called a K-1, consider in all intents of words like a W-2 that you put on your personal return, and then you pay the taxes at your graduated income tax rate, right? But they do have PTE in New York. I do have some people in New York. It's a tough state tax-wise, real tough state. Sorry for you.
Mm-hmm. No, that's helpful. Thank you.
Yeah. Other questions?
Go,
Yeah.
Brian.
I'm just a chatty Cathy today.
We
It's
love
good.
it.
It's good.
So if in going in the S corp route, are there any benefits where you can deduct healthcare expenses and stuff like that that would be different than the sole proprietor type setup or
What do you
individual?
think? What do you think my answer is to that? I love this because then when I do this to people, they remember it.
Yeah,
They remember it.
I think that there would probably be a way to write off more of that.
So medical out-of-pocket costs like copays or deductible or all of that is always personal. It's always
Okay.
personal, no matter what the entity is. The only entity that gives you an additional tax deduction for fringe benefits, and this is what we're talking about is fringe benefits, is the actual C corporation, even though
Gotcha.
we don't advise that, right? So your sole proprietor, self-employed health insurance premiums, vision, dental, medical premiums are 100% tax deductible as
Mhm.
long as we show a profit. As long as we show a profit. Over here, 100% tax deductible as long as we have a large enough W-2.
Okay.
So the key there is what are they concerned about? What do they want? They want the FICA tax on these medical premiums, right? If I want profit over here and W-2 over here, once I saw that, I was like, oh, I see what the government's after. They will allow us to deduct it, but they want to make sure we're paying enough Social Security and Medicare in, because I have people that have walked in the door with an S corp and they never did this W-2. That's playing with fire heavily. When they'll have their medical, it's not tax deductible because they have no earned income, right?
Gotcha.
Even though they think like, oh, I earned this. No, you didn't pay FICA tax on it. Okay.
And I think you briefly touched on the 401k. I finally have
I
I
did.
didn't like the 401k
Yep.
is such a great plan.
Amazing. It's amazing.
And you can't have it as a sole proprietor.
You can.
You
Yeah,
can?
you can. It's just that most people choose to go down the SEP path.
I
You
see.
totally can. Like if I had a small
Okay.
proprietor, it's just that when people have big sole proprietorships, they're just putting a ton away, well beyond the limits of a 401k. Because a SEP, you can put 70K away and it's treated like a 401k. And for you and I and anybody else in the world, it's a different tax code, but in retirement, it's treated the same. Ordinary income, earnings taxed, ordinary income. So, but the 401k, the benefit, here's the biggest benefit, Nancy, I love about the 401. You have an after tax option in 401ks. That means that if you're generating a lot of income and I still want to do a Roth IRA, I can do it without an income test. That's always been the problem with a lot of this is there's an income test to do Roths. I make too much. I can't fund a Roth. I make too much. I got to do this backdoor thing or some other ways to try to get money into a Roth. If you have a 401k, you can actually do after tax. And in fact, if you are if you're over 50, this is a new tax law starting now. If you're over 50 and your W-2 is greater than 150,000, you are actually mandated that your catch-up, if you choose to do the catch-up because you're over 50, that catch-up must go into a Roth now. That's a new law coming into play. That's going to be real fun for people to police. Now, W-2 folks or self-employed people, for this example, we're never going to have a $150,000 W-2 unless I run into like a surgeon S Corp, right? Then I'm going to probably, but rarely do I see W-2s that big for that. Good.
Wow.
Other questions?
Well, we are at time. I could just keep going because I think I learned so much, and this is not my first time at this meeting. I just still keep learning because we didn't even talk
Good.
about HSAs.
I know. Just do it. The long story
Everybody
short, just do it.
Do an
Just
HSA.
do it.
Go Google
Just do
it.
it.
It's the
Yeah.
greatest tax advantage thing you have.
Yeah. Yep.
You're never taxed on that money. Just go do it. Get an HSA ready, and then when you're old, you can just pull that money out tax free. Put as much as you can at HSA.
Yeah.
Okay. Well, Jonathan, muchas gracias. This is so
Yeah, no
good.
problem. Yeah.
Thank you. And I'm going to share your information too with the group again in our Slack channel when we post this. You guys saw the slide. When people come and volunteer their time, I like to also, support their business as well. And I know you have a couple tempo contractors. It does work.
Oh, yeah. Yeah.
So he understands our business. He's got a full team behind him that will support us and freelancers and great asset to have. So thank you so much for volunteering your time for us today. And I hope we can repay you by getting you some
problem. Anytime, Nancy, you just let me know. It's always fun to chat with you. And
we might make you talk about retirement sometime because man, it sounds like you understand that.
Oh yeah, no, I've got all those licenses too.
Okay, good. I'll see you again then.
All right. Thanks, Nancy.
All right, team. Merry Christmas, Happy Holidays, Happy Hanukkah, Festivus, all that stuff.
Happy holidays. Thank you.
Happy holidays.
Yep.
Bye, y'all.
Likewise.
See ya.
Bye-bye.
Thank you, guys.